Welcome to another episode. My name's Jose Najarro, and today we are going to continue to look at a company known as EAF. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company is going. So let's get started. So in the last episode, we took a look at the company's 10Q report and all the information that they provided in the earnings. If you guys want to learn more about that company, feel free to check that video out. If you guys just want to take a look at the financial numbers, this is the right video. And like always, we're going to start off with the income statement. So in the income statement, we're going to take a look at revenue, cost of revenue, and gross profit. Here we can see the revenue for this company has been pretty much flatlined for the past 5-6 quarters. There was a jump up in quarter four of last year, but this company is pretty flat when we take a look at revenue. We do see there is pretty much a small growth going on, but it's not much, as we see this company has most likely hit some form of near capacity on its products. And that's why we can see that revenue is only increasing drastically. Cost of revenue has also did take a nice leap up, and it does seem to flatline. So what does a company need to do better if they hit a revenue capacity, or if they hit capacity of some sort? They have to reduce the cost of revenue as a whole. And this is one thing that they do talk about in their earnings call, that they want to reduce the cost of revenue, and that's something they're developing in the future. So that's definitely good news for the company. Here we can see the gross profit for this company. Like revenue, it is pretty much flat. There's no real ups and downs going on here outside of some noise. But for the company to have a positive gross profit, the first point I'm going to have to do is give to Bull Solo. The next thing I want to take a look at is operating income, earnings before income taxes, and net income. So here the first thing I see is that they're all positive, and that's great news. But what I'm really looking at is to make sure that all of these incomes kind of follow the same results. If they do follow the same results, then there's nothing to take a look at. And here we can see they all look pretty much the same when we take a look at them one by one by one. So that means there's no funny business going on. If there was some funny business happening somewhere, I would be able to see it in one of these charts. So for that, I'm gonna give another point to Bull Solo here. Next, we're going to take a look at my favorite document, and that's the balance sheet. In the balance sheet, I love to see a company with a very strong portfolio. I feel like this is where you can really see if a company is doing pretty well. Right here, we can see off the bat, this company's total assets is much lower than its total liabilities. And that's where we get that shareholder equity. The shareholder equity is the difference between the two. And we can see shareholder equity is definitely on the negative side, negative $709 million of shareholder equity. That means that this company has about $700 million more liabilities than the company has assets. For it to have a negative shareholder equity, I'm definitely going to have to give a point to Darth Bear on this one. As we keep going down, we're going to take a look at the asset distribution and the liability distribution. Let's start off with the liability distribution real quick, and we can see a huge portion of this company's liability is all non-current debt. So that's debt that does not need to be paid off within the that has more than 12 months to be paid off. And we can see this company has about $2.02 billion of $1.99 billion of non-current debt. And one thing we can see is there is a decrease in this non-current debt. This company is paying off this debt over time. So that's definitely a good news. One thing I definitely would not want to see, and if you're investing in this company, one thing I would always keep an eye is make sure this company does not increase its debt anymore. I would not want to see a debt bigger than this. Right now, the company seems to be doing fine. Let's take a look at the cash flow in a bit to see if how this company is doing. But it seems like it's able to maintain this heavy debt and is able to control it, right? Debt is not always a bad thing, right? You need debt to finance stuff, to buy new stuff. As long as you can control the payments on this debt, that's completely fine. So it's just something that as an investor you need to keep an eye on. So that's one thing we'll see in the free cash flow and the cash flow statement sheets. Overall, the other liabilities have maintained pretty flat throughout the quarter. So There's no changes there. This company, like I said, is probably it probably already knows what its costs are, and we can see it's pretty maintained throughout the quarters. This company at this moment, the company has a current debt of $43 million to pay off. Next, let's take a look at the asset distribution. In the asset distribution, we can see that this company is pretty rounded with different items. Right now, the company is sitting with about $205 million of cash and cash equivalents. Right, that's a nice amount of cash when we compare it to its total asset distribution, but it's pretty scary when we take a look at it with the liability distribution, how $205 million in cash and $2.0 billion in total debt. But we can see this company has had this current debt for the past about 5-6 quarters. Let's continue to take a look at the asset distribution. This company has about $313 million in receivables, and that's more than enough to pay the payables. That's one thing I definitely like to see, when receivables is higher than payables. It does have $171 million of intangibles and $314 million in inventory. A huge portion of this company's total assets is property, plants, and equipment. But for a company that's producing something, this is something that you know is bound to happen. So I just want to take out the property, plants, just to get a better look at what's happening with the other assets. And we can see here that cash and cash equivalents has gone up. Just last quarter, it was at $42 million, where this quarter is at 205. Tax assets are pretty much flatlined. And what here has been increasing? Receivables has been increasing, which is pretty good. And inventory has also been increasing. So that's both of those are not bad. Right now, the asset distribution is something I kind of like seeing, and for that reason, I'm going to give a point to Bull Solo. But that liability distribution it seems healthy. It doesn't seem healthy, and when you take a look at it in the overall aspect, right? You don't want to have a huge portion of your company being non-current debt. But I think this company at the moment has been paying off, has been doing well, that the liability distribution is not a healthy one, but it's not a completely horrible one to say. But for that reason, I still think it's not a complete healthy liability sheet. So I'm going to have to give another point to Darth Bear on this one. And it's not as horrible as it seems in the overall picture, right? Because we can see this company is definitely paying off this debt over time, and as long as no new debt gets accrued, then I think this company will be fine. All right, next we're going to take a look at net cash flow statement sheet. Here, the first one and the only one I think I'm going to take a look at today, because looking at the other ones, they're not meant to. There's no real point in looking at them. Right now, it's net cash flow from operations. Net cash flow for operations is what you want to see always positive. This means that the company is producing a positive net cash flow from its everyday use. And here we can see that that's definitely the case. In the past 5-6 quarters, this company has produced a nice, healthy, positive net cash flow from operations. So for that, Bull Solo gets a point. Next, I want to take a look at net cash flow from operations and see how it tracks with revenue. So one thing you want to see, if revenue is going up, you want to see net cash flow from operations going up. Because if revenue is going up but net cash flow from operations is going down, then that means there's something going on. There's some trickery going on with the revenue itself. But right here, we can see that they're pretty much, if you look at them just line by line and not by numerical value, they track each other pretty well. And for that, that's good news. I'm going to definitely give a point to Bull Solo. Next, I want to take a look at net income and net cash flow from operations. And this is exactly like what we just looked with revenue and net cash flow from operations. You want net income to follow these two. And again, it does. And like I mentioned, I already gave the point to Bull Solo on this one. And here is just continues to agree with me that there's no trickery going on with this company, right? Because if this company is producing a positive net income, you also want this company to be producing a positive net cash flow from operations. If it does not, then that means that this company is doing some trickery in its net income, right? What is there to pay after the net income, or it's just collecting fake income at some point, and that's why these are two things that I really like to track at. Next, I want to just take a look at accounts receivable and how much they account for percentage of sales. Here, I again want to make sure that there's no weirdness or no fluctuation, no crazy fluctuation going on. And we can see this company stays within range of about 15 to 20, 20 to 10%. And right now it's sitting around that value at about 16.14%. So there's everything that's a this is trailing 12 months. The day sales outstanding, this is how long it takes the company to collect its money after a payment, after a sale has been done. And I do like that there is a decrease going on in this, right? You want to see that this company is collecting its cash faster. You never want to see a company collect cash slower, right? You want the money to come into the business faster than slower. And this is what we're seeing here. So that's definitely great news for the company. The final one we're going to take a look at are just some metrics. And here are the ones I like to take a look at. First, let's just take a look at gross margin and profit margin. Gross margins for the company have been decreasing overall past the quarters. So that's definitely not a good thing, but as we saw in the last video, one of the big things is cost of revenue has been increasing, and that's definitely going to affect gross margins and profit margins. And we can see, even though the decrease is little by little, this company needs to start reducing its cost of revenue and bring up this gross margin and profit margins. Just because we see a dramatic, not a dramatic increase, and that both values are positive, I'm not going to give a point to neither Bull Solo or Darth Bear, right? Darth Bear has right now the point that it is decreasing little by little, but Bull Solo still has the point that it's not that much decrease. So for that reason, neither of these guys get a point here. Profit margins, right? We see the same thing, right? It seems to be peaked at 49%, and it has been going down 44, 43, 41, 40%, but it's still above 40%, which is still a good value. So, right, both Darth Bear and Bull Solo would get a point here, but I'm not going to give one to either because we have that positive profit margins, but Darth Bear is also seeing that negative decrease. But that decrease is smaller, and we see that this company does have a higher cost of revenue that has been talking about and is trying to achieve future plans to increase this. Current ratio, this company has a very nice current ratio. So this is current assets divided by current liabilities. Here in normal, you just want to see about a 1. Anything higher than 1 is good. This company has a 3.38 current asset to current liability ratio, and that means this company has about over 3 times more assets to pay off its current liabilities. So for that reason, Bull Solo definitely gets a point. Unfortunately, Darth Bear is going to take the point in this debt to equity ratio. This company has a negative debt to equity ratio, and that can only mean one thing. The equity is negative because you can't have negative debt. Well, you probably could, right, if a company is paying you. But right now, we know the case that this company has a negative shareholder equity, and it has such a high debt ratio. It has such a high debt ratio right now, and for that, Darth Bear gets a point. Price to earnings ratio. This company has a very low ratio of 4.04. If we took a look at the last episode, we saw that right now it's probably sitting at about 4.5 ratio based on what earnings per share we're taking a look at is 2019-2020. But this company, right, it does seem to be a company that has capped off in revenue. The only thing it can really do is it is increasing revenue little by little, but the only thing it can truly do is reduce its cost of revenue. And for that reason, we can see investors know this, and for that reason, it has a low price to earnings ratio. Does that mean? I mean, what does a price to earnings ratio mean? It means this is what it means. It means if it takes this company 4 years right now for it to make enough earnings to value at the company's current stock price. So I think 4 years is a pretty low time. And let's take a look at the PowerPoint presentation where we actually looked at it. We were actually right on it. This company, right, has a forward PE ratio of 4.53 with the current stock price based on the earnings per share estimate of $2.89. To be honest, I mean, I think if for a for a company, again, this is where an investor has to feel comfortable how much they're willing to put in for how much amount of time. And valuing a company, I think, is pretty subjective on how much a person is willing to wait. Based on this company, right? A company that has pretty flatline revenue, but a company that's doing pretty hefty shareholder return with buyback programs, and it also has a huge amount of it pays back dividends. It also has 70% of its total capacity already already accounted for, sold for the next 5 years. It has an increase in revenue, and it has an increase of earnings per share. Then a five is definitely easy understandable of forward PE ratio. I personally think 7 years is still pretty easy for that, and for that reason, I personally would be okay paying even up to a seven forward PE ratio. So 289 times seven would give me a price of what? What up? 289 times the price of seven. That's a $20 stock right now sitting at $12. That's almost 100% increase. So the company is definitely, in my opinion, pretty cheap. The only thing that you definitely have to make sure is I wouldn't mind buying EAF, but the moment this company takes on a whole new debt is a time when I would second guess myself. I would leave the company, right? I would definitely leave the company. If this company was to take another huge debt, I'm not saying maybe $100 million debt wouldn't be much, but if it takes another like 1 billion, even $500 million debt, this is a company I would exit out because to me it is not, and it's not able to maintain that. And if it's continuing to take out debt, then this company is doing something wrong. But yeah, I definitely I I'm not too crazy about the stock, right? I'm not too crazy. I definitely enjoy the stock. I think it's pretty cheap. But this is not a sector I normally look at. And that's why I'm happy that it's such a low PE ratio. And like I said, 7 years is definitely not a long time as an investor, right? Think about all the dividends you will be making at that time. So that PE rate, you'll be making your money back in less time than that. So I hope you guys enjoyed this episode. I know I did. Make sure to let me know what other stocks you guys want me to take a look at. I definitely enjoy learning about of other companies. I, as an electrical engineer, I tend to follow more into electrical tech companies just because it's mainly semiconductors, mainly because it's something I truly know, and video games or just companies I know. But I definitely like to learn about other companies. And looking at the numbers is something that I really have fun with. So make sure to let me know what other companies you want to take a look at. And let me know what you think about EAF. Is that huge debt really scaring you guys from purchasing this company? I know many people would not want to buy a company, would not want to invest in a company with such a huge shareholder, negative shareholder equity. But yeah, take care, guys. Have a good night and see you next time.